Krishna, before we go to the parlor game of who might be the next Fed chair, just on the news today, which is moving markets a bit, talk of faster taper. We heard it from Fed Governor Waller, who is a voting member, is a Fed governor at every meeting. Heard it a little bit from Vice Chair Clarida, said it's something to consider and talk about. Is that something you expect the Fed to do, to speed up the taper, given the hot inflation numbers?
So I think this was really quite an important development today, right? Governor Waller is carving out a reputation as a prominent hawk on the Fed board. So it's not that surprising that he should be advocating for a faster taper. But to have Vice Chair Clarida come out with that message that maybe, depending on the data, between now and then, they should be discussing the possibility of an accelerated taper in December. That was news. That was different to what I had been expecting. And I think we have to take it seriously. Now, I do think that we're going to have to see further significant upside surprises in the data to get the Fed to taper, speed up that taper as early as December. But clearly, it's not out of the realm of possibility right now.
The market was already weak, at least the Dow and the S&P, some of those cyclical areas on COVID concerns in Europe and the return of lockdowns. But how do you think ultimately the market would take it if this idea gains traction, a faster taper into what could be a fifth wave of COVID?
I don't think this is something that would be risk friendly by any means. Look, I think if they accelerate the taper in December, you're going to get a frenzy of speculation on a Q2 rate hike, right? And I think you're also running some greater risk that you end up with some kind of taper tantrum discontinuity in the bond market after all the efforts to prevent that from happening. So, look, the Fed has to be responsive to the evolution of the data. But accelerating the taper means that they're essentially giving up on the idea that they should take, at least the first couple of quarters of this year to get a sense of where the data is settling before they make any big judgment calls in terms of the right strategy on rates. That, I think, really starts the ball rolling in an appreciably more hawkish direction.
Yeah, and Krishna, we've got a tweet from Lloyd Blankfein, the former CEO of Goldman Sachs. I'm going to look down and read it. When rates normalize, the risk of a market/economic crisis will be way high. Powell and Brainard are pretty close on policy. Powell's leadership was tested in the initial COVID crisis. Brainard has not been tested the same way. Powell, a much safer choice at a critical moment. Do you agree Powell is the safer, maybe not better, but safer choice? And also, do you think the risk of a market crisis is high when rates normalize?
So I think from a market perspective, Powell probably is the safe choice, right? Now, whether President Biden is really solving for what's a safe choice for, you and me and our friends in the markets, that's a different question, right? President Biden presumably has other priorities, in mind when he's making that pick. But I do think that the Powell pick is the low risk pick as far as the market's concerned relative to Brainard. Look, Brainard is highly qualified and might well make a very good Fed chair. I think the market's initial response would be to see her by reputation as someone who is dovish. So that would tend to be a sort of bit of a curve steepener. I suspect the equity market would tend to trade this risk off at the outset out of greater uncertainty as to how she would run the Fed and greater risk that she'd be tested by the markets. But I will tell you, I don't think Brainard is any kind of crazy dove. I think she would tack to the center quickly to establish her credentials in the market and clear a pathway to confirmation.
She doesn't speak out that often. The last time she was actually on this network, she was on this show, Fed Governor Brainard. And in an interview, I asked her about inflation. Now, keep in mind, this was back in April, but Krishna and everyone else, listen to what she said, how she characterized what we're seeing in terms of inflation in the economy.
There are some unique factors this year that could be expected to push inflation above 2% this year. Obviously, there are those base effects that are going to drop out. So we'll see inflation on a 12-month basis briefly jumping up in April and May. But then later in the year, as the economy opens back up and we see that pent-up consumption coming into the services sector and more broadly in the economy, we could expect to see some bottlenecks in supply chains that also might contribute to some increase in inflation for a period of time. But it's really important to recognize that those are transitory, and following those transitory pressures associated with reopening, it's more likely that the entrenched inflation dynamics that we've seen for well over a decade will take over, then that there will be a sustained surge in inflation for a persistent period.
Now, to be fair, that was back in April, and things have changed. Inflation has only gotten hotter and lasted longer than everyone, including the Federal Reserve, expected. But, Krista, this is why people think she would be even more dovish than Powell. She was firmly in the transitory camp, firmly in the accommodation camp. Would you fade a move if she were named Fed chair, if you did see kind of a move in that dovish direction by the market? Would you fade that, or how ultimately do you think that would shake out?
So I wouldn't push the super dovish Brainard trade too far. I think the market will, price some in that direction to begin with. But I think, look, Brainard has obviously learned a lot about the inflation dynamics and outlook since she made those remarks that certainly haven't aged very well. But I think that, she would be quite a lot more balanced today, in particular, if she shifted to the role of Fed chair, where it's not just about putting forward your own views, it's also about being able to sort of manage the committee as a whole. Now, I do think the issue around Brainard is specifically that she's put a lot of weight on the employment side of the mandate, and specifically the idea that you're not back to maximum employment, which is a trigger condition for raising rates, unless you've achieved the level of jobs that we had in February of 2020. Now, my own view is that if nominated as chair, she's going to soften that view and say that that's a reasonable aspiration. But the truth is that we don't know, at least over a period of, a year or so, exactly how many folks are going to come back and look for jobs. So we should think of that as aspirational goal, not a binary 1-0 go, no go for raising rates.
But, Krista, it's a global bond market. And it's not just our Fed that matters, right? You've got the UK, the EU, the Bank of China, the Bank of Japan. If other central banks begin to get tighter on their monetary and or fiscal policy, will the U.S. be forced to react, even if our own data may not merit it at the time?
I think the odds are actually it goes the other way, right? That
sure,
the
it
US
normally does, but the Eurozone, they are for now, but you never know what can happen, because there have been some comments out of some of the German ministers or whatever that maybe we need to tighten faster.
So you're absolutely right. And in this world, let's be open to all possibilities. But I think at present, right, I would look at it like this. The British Bank of England is going to be the first to hike rates, probably in December. They'll raise rates a few times, but their economy doesn't have the same strength of underlying momentum that the U.S. has. So you're looking at 2 or 3 hikes in the UK, and then the central bank slowing down a lot to see how things go. European Central Bank is going to be a long way behind the Fed in raising rates, both because their inflation dynamics are weaker, also now because they're having this brutal winter wave of COVID. Bank of Japan is a million miles away from tightening policy. So it's actually the Fed that is most likely, at least on a cumulative basis, to be pushing furthest on rates over the next year or two. And that's, of course, why the dollar is so strong right now.